back to my varsity explanation. So it's Sunday, so every Sunday I try to post at least 2 videos for varsity. So let's begin with chapter 1. Okay, so we would select varsity and then try to have the other page as well. Okay, so here you go, we would have the notepad here. Okay, so let's start with the beginner series. Okay, so we'll start with stock market beginners and then let's start explore the first chapter. So in the first chapter we have one, a need to invest, 2, financial regulator and intermediates, 3, the IPO market, and then that's it. So we have basically I'll try to write it here. So we basically have 3 chapters to cover in the first module. Okay, number 1 module. Okay, so I'll just have the first one. So here first one I'll try to reduce the size so that we can have more space. Okay, so yeah, this would do. Now I'll just try to make it a little bigger. Okay, so now this is effective. Okay, why should I invest? Okay, before we address, okay, let's change the color to yellow. So yeah, okay, this would help. Okay, why should we invest is the topic. Okay, so first one, before we address the above question, let's understand what would happen if one chooses not to invest. Okay, assume you have earned 5,000 rupees per month and you spend 30,000 towards your day-to-day living. This can include expenses like housing, food, transport, and shopping, medicals. These are like the 5 basics. Okay, now the balance 20,000 is your monthly surplus. That is your you are saving, trying to save on. For the sake of simplicity, let's ignore the tax effect on this discussion. Okay, to drive the point across, let's make a few simple assumptions. Okay, so these are the assumptions. What is that? Employer is kind enough to give 10% hike every year. Okay, so you'll be getting 10% hike. The cost of living is likely to go 8% yearly. So inflation you should always keep into the calculation. Okay, you are 30 years old and plan to retire at 50. Okay, this translates to 20 years of working life in your whole life. Okay, so you don't intend to work after you retire. So let's calculate how things happen if you plan to retire at 50 and then you are not intending to work. Okay, your expenses are fixed and you don't foresee any other expenses. So this is like the assumption we are making here. With food, housing, transport, and shopping and medicals, we are leaving all the other extra stuffs, and the balance 20,000 you are just having a hard cash. Okay, so now we'll move to the next page. So this is like the tabulation they have made. Okay, so going to the assumptions in the previous card, here is the calculation. Here is what the cash balance will look like in 20 years. So what is that? So this is how they have calculated. Okay, you can check by yourself in the varsity website. Now I will just read the explanation. Okay, so here again we try to select. Okay, we'll make it a little smaller. So this line you see, after 20 years you are accumulating 1.7 crores. Okay, since your expenses are fixed, your lifestyle has not changed over years. You probably even suppressed your lifelong aspiration like a better home, car, vacations, etc. So that is excluded. Okay, after you retire, assuming the expenses will continue to grow at 8%, that is inflation, the retirement corpus of rupees 1 crore is good enough to save you through roughly 8 years of post-retirement life. Oh my god, just 8 years. Okay, 8 year onwards you will be in the tight spot with literally no savings left to your backup. So this is just a basic example how you could say you are starting at 30 and then having a retirement at 50 and then you are saving 1 plus crores money and then this is what happens. You can only, with that money you can only manage for 8 years. Okay, what would you do after you run out of money in 8 years? How do you fund your life? Okay, after 50 years, is there a way to ensure that you collect a more considerable sum at the end of 20 years? Now this is a big question for everyone, so let's see what the explanation has to give. Okay, now here, this is the investment plans they are trying to show us or teach us with basic example. At this point you may think that the assumptions are simple and that real life does not work like this. Yes, of course it doesn't work like this, right? I agree and I won't dispute the fact. Okay, however, the point to note in the above calculation is that no investments are made. Okay, so you are not trying to invest anything in your working life, that is from 30 to 50. Hence the cash retained has a flat zero growth. Okay, so whatever cash you are trying to save as a cash without investment is just having a zero growth, plus inflammation inflammation, no, not inflammation, inflation. Yes, inflation is okay. So I'll try to erase all this part. So what they are trying to say is inflation is one of the biggest thing you have to take into account if you are holding just cash. Okay, that's what they are the main point is. Okay, so let's consider another scenario where instead of keeping the cash idle, you choose to invest the cash in the investment option that grows at, let's say, 12% per annum. So that is important, 12% per annum. You are choosing some investment plan. For example, in the first year you retain 2,40,000, which when invested at 12% per annum for 20 years, that is you're working like that, like 30 to 50 you are going to work, right, then retire. So you are trying to take the cash from this and trying to invest with 12% rate of rate of profitability for your investment. Okay, so how that works, this is the simple calculation. So you see here 2,40,000 times 1 plus 12% to the square of 19, that is your working hour years. So this would give you somewhere around 2 plus crores. Don't worry about the math at this point, we'll explain the later in this module and several other models and varsity. So they are trying to explain. Okay, so we'll just take 2 crore plus is what you will get after you are investing that cash with 12% returns. Okay, here is how the table looks. So you can see this, let me just show you, and this is how you grow from year 1 to year 19. Okay, so having figured out the reasons to invest, the next obvious question is, where would one invest? Okay, right, the investing, where you should invest, that's the bigger question. Okay, and what return can one expect with investing? Okay, so returns is also important if you are investing. Okay, when investing, one has to choose a asset class that suits the individual risk and returns profile. Okay, so the RR ratio is very, very important. Okay, for example, one individual will be open to taking a lot of risk with his or her money, while another may want to take moderate risk, and then while another want to take zero risk. Okay, so higher risk means higher returns, lower risk means lower returns. So this is the golden rule for stock market. While you take the other investment like gold, land, etc., these always vary and carry a lower risk, while stock market carries the higher risk. Okay, so let's just move forward. Okay, think of asset class as an investment vehicle defined by its risk and return characteristics. Okay, the following are some of the popular asset classes. So these are the popular ones: fixed income instruments, that is FD, Then you have equity, that is stock market, and then you have real estate, that is land, and then commodities like gold and silver. You can also carry other items, but gold and silver always holds the top position. Okay, so these are the popular investments which you can make. And then what they are trying to say, okay, so the fixed income instruments are investment avenues where your principal amount, the money you invest, is perceived to be safe. Okay, so fixed is always safe. Fixed is safe. Okay, and then what they are trying to say is the entity pays an interest amount on the principal you invest. Okay, the bank fixed deposit scheme is the simplest example of a fixed instrument. The interest paid could be quarterly, semi-annually, and annually. Okay, and for that you have to pay TDS as well at the end of the, whenever you take out your money. Okay, the capital is returned to the investor at the end of the investment period, also known as the maturity period. That's what I was trying to teach you. The maturity period is important, where you have to pay tax, but here we are not considering the tax. Okay, a few example of fixed instruments. So FM fixed instruments are these, that is fixed deposits, bond issued by the government of India called as G-Sec bonds or T-bills, that is treasury bills, then bonds issued by government related agencies. So they are not technically government, but they are, government has given the rights for them to hold the bonds or issue the bonds, and then bonds issued by the corporates, so like Tata, Bajaj, Reliance, Adani, all these are corporate. Okay, see. Okay, as per October 2022, the typical return from a fixed instrument bank FDs varies from 5 to 6%. Okay, so let's just remove everything. So 5% from FDs. Okay, government bonds offer you about 5%, that is also same. And then the few corporate bonds offers up to 10%, but that also has the risk and reward ratios. Okay, but these are fixed, so you can expect a little bit of less risk. Okay, the rate across the different instruments vary because of the risk varies. Okay, the government bonds are considered the safest investment with zero risks to the investment, because while the government can't cheat and run away with your money. Of course, government runs, right? Government runs the country, so it is definitely going to be a very low risk. I'm not telling the risk is zero, but the low risk. Okay, corporate bonds are risky through investments in corporate bonds can go to zero. So this is completely risky when it comes to corporate. Okay, and we have seen plenty of such examples in the past. For example, Yes Bank. Okay, so we'll move to the next page. So equity. Now we are coming to stock market. Okay. So here in the equity section, you'll see investments in equities involves buying shares of publicly listed companies. This is important part you should know. So what is publicly listed companies? They actually come to stock market to showcase their company in public sector, so that others can invest, and then if the company tries to grow up in the future, then the investors would benefit nicely. So there are two exchanges, that is BSE and then NSE. So they have listed that. When an investor invests in equity, unlike a fixed income instrument, so equity is completely related to stock market. Okay, so when an investor invests in equity, unlike a fixed income instrument, there is no capital guarantee. Okay, so here market can go anywhere, so that's what they're trying to focus. However, as a trade-off, the returns from the equity investment can be much better. Yes, this gives the return of 12%. Okay, which is like the highest. So mutual funds are one of the examples. So let's try to break down. Indian equities have generated up to 12% compound annual growth rate over the past 15 years, 10 to 15 years. Investing in some of the best and most well-run Indian companies can yield up to 20%. So from 12%, it can actually go to 20%. So imagine some person invests in a stock market, but it has risk. I'm telling you, 20% is a very good amount. Okay, identifying such investment opportunities requires skill, hard work, and patience. Yeah, definitely. For example, you can take Warren Buffett. So you go through his investment strategies. He will teach you like the best thing you can learn from about stock market. Okay, his life is very inspiring. Also, Rakesh Jhunjhunwala from India. His investment strategy is also very popular. So now comes the real estate. So they have covered FDs, government bonds, and they have covered equity, and now they have come to real estate. Okay, so here real estate investments involve transacting, buying and selling commercial or non-commercial land. So yeah, typically buying land. Typically examples include transacting into vacant plots, apartments and commercial buildings. Okay, there are two income sources from real estate investment: rental income, that is monthly, yearly, weekly, 6 months, fortnightly, etc., and capital appreciation. So for example, if my grandfather has a land which has valued for 10k in 1770s, 1970s, now that would reach to 1 crore to 2 crore. But you also have to calculate inflation in the account, but I'm telling you the example. So this is a real-time example. So the rental yield also they will be getting between 2 to 3%, which is not so attractive in my opinion. But the capital appreciation of the land is actually a bit, but it also depends upon the where the landed property lies. Okay, if you are buying in Singapore, then of course your land value would appreciate. But if you buy the same land for in Australia or in USA, then you would see a much appreciation because of the growth of the countries. Okay, the transaction procedure can be quite complex, involving legal verification of documents. The cash outlay in the real estate investments is usually quite large. Okay, there is no official metric to measure the returns generated by real estate. Hence, real estate comes in the first position. Hence, it would be hard to comment on this. Yeah, of course. Now here we would see commodity. Commodity includes, I told you, gold and silver. Okay, so here gold and silver are considered one of the most popular investment options. Gold and silver over the long term has appreciated. Of course, definitely they would have appreciated. Investment in these metals have yielded a CAGR return of approximately 5 to 8%. 8% max for 20 years is not bad. Okay, so yeah, there are several ways to invest in gold and silver. One can invest in jewelries and ETF and sovereign bonds, etc., and these are the popular ways. Okay, I think the video is going a little bit longer, so we would cover one chapter by chapter. Okay, one of the sessions. So now asset allocations. Now how we have to do the asset allocation. So here you have to, so going back to the initial example of investing, the surplus cash, it would be interesting to see how much one would have saved by the end of 20 years, considering he has invested in one of the listed things. So by investing in fixed income with 9% per annum, or corporate bond, or the corporate bond or government bonds, okay, the corpus would have grown up to 3 crores. Wow. Okay, so with zero investment we have 1 crore in hand, and with one of the investments gives 3 crores. Investing in equity would have given you 5 crores, and then equity, and then investing in bullion, that is of course the gold or silver, would have given you a 3 crores. So see, without investing it's just 1 crore, but with investing your rate for the cash has been gradually increasing year by year. Okay, equity tends to give you the best returns, especially when you have a multi-year investment perspective. So now they haven't discussed about equity. In the next chapter we are going to discuss about the equity. Okay, so I think this investing topic we will go in the other chapter.